There's this old saying, you're in rarefied air. I'm not exactly sure what it means, but when we have David Rosenberg on the podcast, Dan Nathan, it is, in fact, rarefied air because he is sort of at the pinnacle of a lot of the things that we talk about. You quote him once a week on Fast Money. We probably bring up his tweets a couple times a week on Market Call. But it is once again an honor to have David Rosenberg with us. Rosie, how are you?
Doing great, thanks. As well as my beloved Montreal Canadiens on the golf course.
Dude, unbelievable. You're talking about a drought of epic proportions in Montreal. It's one thing for the Yankees to go 14 years without a World Series, which is a problem. But when the Canadians go more than a 3 or 4 year period without a Stanley Cup, I mean, they're ready. I mean, they are not happy up there in Habtown.
No, I got to say it hurts. I'm a Habs fan. I'm a Mavis fan. I'm a Colts fan back to the Johnny Unitas era. And I'm a Yankees fan. And I got to say that I got a lot of spare time these days. I've given up on sports.
Hey, Rosie, I'll let you know this. I mean, you know that the national sport of Canada is lacrosse. I played lacrosse in Toronto for 2 summers when I was in college and ready for the years 1992 and 93. And I got to see every team in the American League come through in those 2 years. And Toronto would line them up and knock them down. And they won those World Series. It was kind of, for me as a lax guy, it was pretty cool to be exposed to that sort of winning tradition up there. They have not won one since then, Guy. But I will tell you, in 1996, I did move to New York City, and that your team, the New York Yankees, went on a bit of a run in the late 90s.
That's exactly, went on an epic run. So you had some decent baseball without question.
In '94, you had the Rangers too, didn't you?
94 was a magical year at Madison Square Garden.
Mateau.
Knicks took, I want to say they went 7 with the Houston Rockets, only to lose because John Starks had one of the worst games in the history of the NBA playoffs. But that's not why folks are tuning in. So this is, as we're taping this, it's a Wednesday. Earlier today, we got a CPI number that was out. 4.9% was softer than the 5% anticipated, but the core rate of 5.5% was in line. You know, this is my assertion at this point. I think the Fed's a bit of a sideshow at this point. I don't necessarily know if they matter, but what does matter is something that you've talked about, the lag effect of Fed rate hikes. And you have said in some of your notes that it's 15 months, 1-5, when things start to take hold. And if my math serves me well, we're probably about at the 15-month mark. The S&P has gone nowhere for a month, but things should start happening right about now, David.
Yeah, I would tend to agree. And look, the stock market has frustrated the bulls and frustrated the bears. It's just been range trading, for the past several months. But what gives it away, and why I think that there's going to be a break coming. Either way, we're going to break out above 4,200, or we're going to break back down to the October lows or below the October lows. And what gives everything away is the market breadth, which has been extremely poor. And that's why once the very expensive generals begin to fall, you're going to find a much different stock market. I mean, the whole glue keeping it together has been basically 8 mega cap stocks. Outside of some special situations, medical products, home builders, a fraction of a percent of the index. It's been a very unexciting stock market. And my sense is that if you're taking a look at all the major averages, I think you can argue, because when you look at credit spreads, high yield at 450 basis points, the markets are telling you, maybe we're going to get through this with a soft landing. And I think that's where the cyclical stocks are going to have a very big surprise. The value stocks will have a big surprise, because I think the notion that we come out of the most pernicious Fed tightening cycle since 1981 with no outright recession. I'm not talking about a rolling recession. I just debated Ed Yardeni in the Malden conference. Rolling recessions, no. I think that an actual NBER recession, where you get an actual haircut, a national pay cut to GDP, a different animal altogether, and it's not fully priced in. So if you believe my view that recession is staring us in the face, you want to be unduly cautious right now.
David, what is some of the biggest pushback you get? And it's amazing. I mean, like Ed Yardeni, we both have a lot of respect for, and he's been around for a while, and he tracks a lot of the same data that we're all looking at, right? So, you arrive at a very different conclusion. Guy and I are not economists, but we look at things through the lens of the market, and we see a level of complacency, really poor breadth, the concentration that you're talking about. We see some of the things that have been huge S&P 500 contributors, like energy, starting to kind of really give back a bit. You know what I mean? If we didn't have the energy contribution, look at the way an ExxonMobil last week or 2 weeks ago, after it made a new all-time high, after a record quarter, dropped like a lug. It seems like investors have been very crowded, not just in those big names in tech for safety reasons. And that, I think that got increasingly, evident during this kind of banking crisis. We're going to hit that a little bit later. I'm just curious, like what are some of the major pushbacks you have? Because to me, if I'm looking at, not just the equity markets, but across, all different asset classes, I see warning bells screaming in silence. And it does remind me a little bit of the '07 sort of period, in the lead up to the financial crisis. I don't mean that the stock market is going to crash, but I really feel like the level of complacency here and the concentration is a really dangerous cocktail right now.
Right. Well, look, I don't know if I'm getting a lot of pushback on the stock market call. I think everybody is pretty well confused. All we know for sure is that the 2023 highs of 4,200 are acting as pervasive resistance, and then you got the 21-day and 50-day moving averages acting as technical support, and we've just been fluctuating in that range. If you have to make a bet which way we're going to go, I say we're going to go lower for the reasons I cited: recession risk not fully priced in, and the fact that the market breadth has been lagging significantly. The pushback I get mostly is on the recession call, because it's just like our friend Sarah Eisen said yesterday. Where's the recession? Look at the employment numbers. Look at 3.4% unemployment rate. And that's where I get most of the pushback, that if there's going to be a recession, well, most certainly employment conditions wouldn't be as robust as they are. And my response is that employment is always the last man standing heading into recession. In fact, it's not unusual to have employment still rising in the opening months of recession. The unemployment rate usually bottoms 3 months into the recession, as it peaks 3 months after the recession is over. These are coincidental lagging indicators. But we're seeing, I would just say this much, we're seeing cracks in the labor market, the forward-looking indicators. Temp agency employment has been rolling over and declining. And you start to think, because that's a leading indicator. Why? Well, because when the headhunters start to chop heads, what does it mean for everybody else? And another leading indicator are the downward revisions, which we saw. Everybody talks about the great number for April, but actually, the revisions to the previous 2 months were so big that the level of employment in April actually was lower than the level that was being penned in by the consensus. Nobody talks about that. But downward revisions are actually very pro-cyclical in both directions. And then the mother of all leading indicators is the work week. And the work week is down 0.6% in the past year. Over the past 3 months, the decline in the work week has actually superseded the headline employment. What happens at turning points in the cycle in both directions, and why it is that the work week is actually in the index of leading indicators by the Conference Board. Employment, non-farm payrolls, is in the coincident indicator, and unemployment's in the lagging indicator. We want to focus on the leading indicators. The work week, which nobody seems to talk about, has been contracting. And what happens at turning points is that businesses cut the hours before they cut the bodies. So it's not so much, I'm not going to debate, will we get revisions to the payroll numbers? We know we're going to get revisions. Are they being overstated? Well, we know that the birth death model, which has been accounting for about 40% of the headline, yes, it's been overstating the headline. I'm more interested, where's employment going to be 3 months from now, 6 months from now, a year from now, than focusing on, where was it last April. And the leading indicators are telling you that we're seeing some cracks emerge in the jobs market that isn't readily apparent at the headline level just yet.
And I've read your work and you've talked about that, written about that. And so here's, I'm not playing devil's advocate, but part of the bull thesis is taking all the points you just made and saying the market is turning, the job market is turning. And that's actually a bullish thing because it somehow means that the Fed's job is being done for it. They are now out of the picture. Some people are pricing in Fed rate cuts in the back half of this year. So they'll actually take that negative that you just outlined so eloquently and say, actually, that's a positive for the market. And I think you've seen it play out a number of times over the last couple months where bad news is effectively good news for the market. At what point do you think that ends?
Look, I think that we have to differentiate between what's a trade and what's a trend. So I think that you're 100% right that you can take, sour cream and turn it into ice cream and say, well, job losses are going to be good for the market because it's going to get the Fed to cut interest rates. And that's most likely going to happen. But you see, once you start to have the employment go down, the impact on aggregate demand is negative. And then you get declining consumer spending, which feeds right into a more pernicious profits recession, which has already started. And yeah, the Fed, I think, will be cutting interest rates, but I don't think you're going to find a time in a recession. Like, it's different if we're talking about a soft landing financial calamity. The repo market blows up in the Fed's face in 2019. Powell pivots, cuts rates. There's no recession. Market takes off. You have the situation, for example, in call it in 1998, long-term capital Asia, not a recession in the U.S. The Fed cuts rates, market takes off, no recession. You see, when these things happen, you have the 87 collapse, no recession. The Fed cuts rates, market takes off. But totally different animal when you get the NBER recession. Because an NBER recession is not, you see, in a soft landing, it's your bonus that gets cut. But in a recession, it's your salary that gets cut. And so what's going to happen is that the Fed naturally is going to pause, and then it's going to pivot. And usually there's a lag, 6 to 9 months between the pause and the pivot. Unless there's some sort of financial calamity, the Fed's not going to turn on a dime. The Fed is a very incremental, slow-moving, deliberate institution. But they will end up cutting rates. Now, you'll get a trade out of it. I remember being at Merrill in the summer of 2007 when they didn't just pause, they started to cut rates. And I think the S&P 500 went up 5% that day. My phone was ringing off the hook. You go back to, let's go back to Greenspan, January of 2001, when Greenspan finally realized, oops, no, sorry, this isn't just a inventory correction. This is a devastating deflation in the technology capital stock. So on the first trading day of the year in January of 2001, Greenspan's cutting rates intermeeting 50 basis points. Market surged. And you can go back and forth and you'll see historically, in that first Fed cut, there's euphoria and you can trade that. But it's a rally you want to rent. You don't want to own it. Why? Because the market will go down and go down, and there'll be multiple lags because of the bad economic and financial news. You see, what happens with a recession is that it impairs corporate cash flows. So it's not just employment you're talking about, Guy. It's going to be also risks to credit and defaults. And what happens in that environment in a recession is you get credit spreads widening dramatically. And that has knock-on impacts back on the equity market. You just get general risk aversion. So you'll get periods where the Fed cuts rates, the market rallies, and then roll over again. And that's just the cycle at play. That's a situation where history repeats. It doesn't rhyme. The markets will ultimately bottom. And when will the markets bottom? When we're 70% of the way into the recession, when we're 70% of the way into the Fed easing cycle, and only when the Fed cuts rates sufficiently, we talk about pivot to repivot the yield curve to a more normal positive slope. People still don't understand. We're living through a very unusual period right now. It's not normal. It is not normal for the yield curve. It is not normal for long-term rates to be below short-term rates. We can dream up all sorts of reasons why that doesn't matter, but it's the bond market's way of saying to the Fed, Uncle, you've gone too far. And it's got a perfect track record. When the Fed tightens into an inverted yield curve, recessions occur 100% of the time. It's not even 99.9. It's 100%. And so what the stock market will have to see before we put in the ultimate low is the whites of the eyes of the recovery. We haven't even started the recession yet. Now, I've never seen a fundamental bear market low take place before the recession starts. I've never seen the stock market bottom ahead of the end of the Fed tightening cycle. And normally the market bottoms, as I said, basically seventh inning into the recession, seventh inning into the Fed easing cycle, and only when the yield curve has steepened, I tend to find that the real alarm bell is when 2s10s is plus 140 basis points. I mean, where is it right now, guys? Like negative 50? And we have to reestablish a more appropriate equity risk premium. At the lows, the stock market gets stupid cheap uh, in absolute terms and relative to bonds. So when you start to see the ERP get to 425 basis points, which is more than double where it is today, and it's going to need the Treasury market's help. It's why I'm bullish on bonds, because there's not a snowball's chance in hell, actually, that we're going to be putting in a low in the stock market in advance of a much bigger rally in bonds. Bond yields need to come down to give that relative support to the stock market. So I'm just thinking, what is the low? What is the matrix of a 425 basis point ERP? Would be something close to 2.5% for the 10-year note and something close to 3,300 for the S&P. And we get to those levels in the next year. And Dave Rosenberg morphs from being the perma bear to the perma bull. And you guys heard it here first.
Yeah. Well, we're breaking news here, Rosie. Listen, we've been tracking, our friend John Butters over there, who runs the Earnings Insight blog at FactSet. They track, where the forward PE of the S&P is trading. It's about 18 times right now. That's below the 5-year average of 18.6 and just above the 10-year average of 17.3. And you think about those average periods where interest rates were, to your point, that makes, equity valuations look obscene in our opinion. And especially when you layer in just how you just kind of suggested, how we will have not bottomed, I guess, in front of this recession that you're calling here. So, I just want to mention one other point. You said that, the Fed will lower interest rates, but it's going to do to some sort of calamity. And if you think back to what we started to see in March, right, in the regional banking sector, I mean, we've had a calamity of epic proportions, right? And you could say it was caused by, a lot of these risk managers at these regionals not really paying attention or not believing that the Fed was going to do, raise 500 basis points in about a year or so. That is what it is. But I look at the BKX, and it's down about 35% since the start of February. I look at the, regional banking index is down about 45%, very near their multi-year lows here. It doesn't feel like that calamity is over yet. And I look at some of the money center banks here and just the poor performance of a Bank America, just a few percent off its lows, 52-week lows. Give us a sense of how you're reading what's going on in the banking sector. And is it likely to be the cause for the Fed to lower interest rates sooner than some people think they might do?
Well, I think that probably is the case. And we have to also assess that there's not been look, there's been Fed tightening cycles that have not pushed the economy into a recession. Okay. We've had 14 Fed hiking cycles since 1950, and 11 of the 14 landed the economy in recession. Now, there were 3 periods where that didn't happen in the mid 60s, the mid 80s, and the mid 90s. Remember, in the mid 90s soft landing, that's when we started to label Alan Greenspan the maestro. But you see, in each case, the Fed stopped tightening before the yield curve inverted. This time around, in order to crush inflation, uh, the Fed kept on going and kept on raising rates to this day in the face of an inverted yield curve, just like Paul Volcker did. And at every opportunity, Powell's compared himself to Paul Volcker. Now, I'm digressing here a little bit because I said that there were 3 instances where we didn't have a recession, but in every instance where the Fed tightened policy, we had some sort of financial calamity. I'll give you, and sometimes it was just once. The Fed raised rates once in April of 1997. We have the Asian crisis. Why they raised rates, the U.S. dollar took off, and then we saw what happened to these currencies that had to get devalued, starting with Thailand. How could you ever know we're going to connect the dots from April 1997 tightening to the Thai baht devaluation and then everything that happened thereafter? There's never been a Fed tightening cycle that didn't end with a financial calamity. It doesn't always, by the way, mean that it's going to be the banks, but there's always been a financial calamity. 1995, 1994, the Fed doubles the funds rate 3 to 6%. Yeah, it wasn't a recession, but I wouldn't tell anybody in Orange County they didn't have a recession. And then we had the Mexican crisis. So I wouldn't tell anybody in our southern amigo that they didn't have a recession. So this time around, you're right. It's back to not the big money center banks, but the regional banks. The small banks aren't so small anymore. So this has a taste of the late 80s, the savings and loan crisis. And who's the poster child, just like back then? Debt financed, overbuilt, over-levered commercial real estate. So no, it's not about residential mortgages this time around. That was the last war. This is about, but also a very huge space. It'll play out differently, but it comes out the same, which is that we're going to have a massive credit squeeze on the economy, and heading into Silicon Valley Bank and First Republic. Like before this, the banks are already starting to tighten their credit standards. We got that in the first quarter. Senior loan officer survey came out before this banking mess, and we were starting to see a lot of the rot surface in credit cards and subprime auto loans, in CRE, in commercial industrial loans. It was already starting. The banks were already raising the loan loss provisioning, and they were tightening credit standards before this mess. And then we just got the second quarter numbers, and it got even worse. These survey data. Now, there's this fellow, his name was Chuck Friedman. He was the number 3 guy at the Bank of Canada in the 1980s and 1990s, who told me once that the best leading indicator for GDP is the senior loan officer survey. And it's basically got the recession label written all over it. So, yeah, this is going to lead to tighter credit. So not only do we have a 500 basis point increase in the cost of credit, but we're now going to bump that against the availability of credit for a credit-driven economy. And then we haven't talked about the fiscal squeeze that's coming. No matter what happens with the debt ceiling, we're seeing a fiscal squeeze on top of a monetary contraction and credit restraint. And even for this large, sophisticated beast called the U.S. economy, it's going to be too much to bear to prevent a recession from happening. So, of course, the Fed's going to be cutting interest rates. I think that you just have to sit there and wait. They're tightening into an inverted yield curve. An accident was going to happen. An accident was going to happen. Where was the brick going to fall? Well, now we know. The regional banks. Not the first time that's happened, by the way. And commercial real estate, which is the new residential mortgage problem. It's not nearly as, I wouldn't say that there's counterparty risk. It's not as severe as what happened the last cycle, but it's going to cause the banks to have to raise capital. They're going to curtail their lending activity, not for their credit-worthy borrowers, but for everybody else. And it's going to have a major impact on GDP that we haven't even seen yet. Now, the problem for the Fed, like I said before, they are slow, deliberate, incremental institution. And they're going to be way too late. They were too late coming out of the gates with the reopening trade and all the fiscal stimulus. And the inflation genie got out of the bottle, and now they're going to be late on the other side. So, yeah, they'll be cutting rates. They'll be cutting rates. In fact, I don't think there's enough rate cuts priced in. I think the swaps curve has 2. Well, look, I'll just say this much about the Fed. I mean, they've given it to us on a silver platter. First, let's just put this recession debate to bed, okay? Because the Fed staff at the March meeting, we know this from the minutes, the Fed staff economists, okay? Now, I'm not going to I'm not going to bow to the holy grail of the Fed staff economists, but they do have a fairly sophisticated macroeconometric model, okay? And they say in the minutes, and I love the transparency, they didn't have to tell us this. The FOMC actually disagrees. But the Fed staff model says mild recession, however you want to define mild. We had a mild recession in 2001. We still had a 60% drawdown on the stock market. Mild recessions don't guarantee you anything when it comes to financial asset pricing. They're telling you we're going to have a recession. The Fed staff model, so let's cut them a break and say that maybe the Fed staff model has the call better than Jim Bullard does or anybody else on the FOMC. I'm not even sure. I think actually the new guy in Chicago, Goolsbee, I think he's actually a breath of fresh air. I think he's basically got my call, although I don't know why he raised rates. He voted for the rate hike at the meeting of a couple of weeks ago. But they've told you the Fed staff model is that we're having a recession. What does the Fed do in recessions historically? What do they do? What do they do? They cut rates to a T by 500 basis points. So we're going back down to the zero bound if we get a recession. It's a matter of timing. It's a matter of timing.
Let's play this out because let's say it is rate cuts in the back half of this year, which, by the way, I mean, we're sitting here early May. The back half of this year is coming a lot faster than people realize. US dollar is going to get whacked on the back of that in a way that I don't think people really understand. And some of these commodities, which have gotten back on their horse, are going to continue to ride that horse. And the inflation genie that's out of the bottle is going to remain out of the bottle. So they got a real problem on their hands. So let's just sort of couch that for a second and go back to sort of the banks and the importance. Listen, you know who's getting hurt right now in the banks are shareholders. And I think we can all tolerate that, just the nature of the game. But it's bigger than that because, as I've said, and I think I'm right, but I love your thoughts, the backbone of this economy, the employment picture at least, is driven by small and medium business. I think they employ more than 65% of the people in this country. If you think about the economy, it's driven by people buying shit to the tune of about 73%. The lifeblood of small and mid-sized business are regional banks, banks that are in their neighborhoods that understand the businesses. Those banks are compromised. People are taking deposits away. They're going to the larger banks, which quite frankly don't really want to or in the business of serving small business. So if small business is compromised, almost by definition, the economy is compromised. Am I onto something with that?
You're 100% right. Well, firstly, I mean the big banks don't even want these deposits, and the reason why these small companies even had deposits anyways at these regional banks was because they were also accessing a whole bunch of other services from these regional banks that Jamie Dimon, was never going to provide. So I think that you're 100% right. This is what we're staring. That's what's staring us in the face is a contraction in credit to 2/3 of the economy, which is small business, and it's chapter one. I mean, that's Jamie Dimon, to his credit, only said this chapter's over. He didn't say the book was over. It'd be like saying in 1989, oh, the savings and loan crisis because we created RTC, that's over. No. That was a 3-quarter recession with no recovery for like 3 years. Greenspan was still talking about 60-mile-an-hour headwinds in 1992, 2 years after the recession technically ended. So I think you're 100% right. And the point I'm making about the inflation genie, I mean, look, inflation got to 9% in June. It's down, it's slightly below 5%. Inflation has come down as fast under Powell as it did under Volcker back in 1982. Inflation's coming down. Now, inflation, it's an economist's dream, a race between watching paint dry and grass grow. But it's not Bitcoin. It's not the S&P. I mean, it takes a while. Inflation is coming down. The inflation genie, come on. The inflation genie was COVID, all the variants, massive supply constraints, ridiculous fiscal stimulus that was unnecessary, monetary stimulus that was unnecessary, all in the rearview mirror. The stimulus checks have now, the Energizer Bunny has run out. Energizer Bunny has run out. And you know where you saw it? You saw it with Airbnb's negative revenue guidance. It's done. That party is over, uh, and what we have staring us in the face, credit squeeze. Where Biden, I mean, they're going to have some sort of compromise, but the only thing that's going to come out, the only thing that's going to come out of the banking sector mess is a credit squeeze. The question is duration and magnitude. That's it. We're going to come out of this debt ceiling mess with fiscal contraction. It's just a matter of, I mean, even Biden said, well, do we have to do this now? But I'm ready to talk about spending restraint. Now, is it baffle gab? Who knows? But we're coming out of this, my assumption, with fiscal restraint at a time when M2 is negative 4% year over year. Monetary contraction, credit contraction, fiscal contraction, guy, and we're talking about inflation, which is a lagging indicator, a 12-month trend at 4.9%, 12-month lagging trend. Where is that sucker going to be 12 months from now? I'm going to tell you, I think it's going to have a minus sign in front of it. I think it's going to have a minus sign in front of it.
Well, Rosie, to your point about what the Fed's model is saying about growth, okay, when you think about that, okay, so we have a projection for very sluggish to negative growth, and when you think about where we were pre-pandemic, we were obsessed with deflation, right? Like that was like one of the big concerns, and so again, I think that all of this, to Guy's point, makes the Fed's job that much harder. It also makes the likelihood of a mistake that much greater. And I think that a lot of us were in the same camp during 2021, keeping rates as low as they did for as long as they did and continuing to buy $120 billion worth of treasuries and MBS seemed like a little asinine, if you will. But let me go back to raising rates into an inverted yield curve into a recession. Okay. So you brought up the point about the maestro back in, and I think that, Guy, you might have coined that maestro term for your main man back then. But the Fed was aggressively raising rates right into like 1999 into the highs of 2000 in the stock market. And to your point, we got above 6% Fed funds. The S&P got cut in half over a 2-year period. Again, we went from 1% right in the mid 2000s up to just over 5% into 07. The S&P got more than cut in half again. We started raising rates off of a zero interest rate bound in 2015, right? And what happened into 2020, right? We saw the S&P go down 35%, but we threw $5 trillion, right? A monetary and fiscal at that. And that created inflation. And then once again, okay, and I hate to be redundant here, but, we started this interest rate increase here. So I guess does 2022, and I know the answer to this, it's kind of rhetorical. We had this sell-off of about 30% in the S&P 500. We only closed down about 20 or so percent or so. Here we are now, okay, and you just said it. The Fed just raised interest rates a couple of weeks ago. I just don't understand the soft landing or the no land. I just don't know how it happens that was it, that October of 2022 was the bottom here. Explain to me, though, how that could happen. How could we avoid this? How could it be different this time, David?
Well, I don't think it's going to be different this time. But look, when Jay Powell practically used those words at the press conference, so if you're a devotee of the chairman of the Federal Reserve, then you would buy into that view. I think it's a triumph of hope over experience. But I've been doing this for 40 years, and the consensus is always for the soft landing up until such time as you get a real bad run of employment losses and the unemployment rate is up, say, more than a percentage point. And what happens, because that's the business that we're in, optimism will always overplay pessimism. And we have to understand that, something else from history is that 85% of the time, historically, we're in a bull market. And 85% of the time, we are in an economic expansion. But there is that 15% of the time when we're not. And recessions are joined at the hip to expansions, just as bear markets are joined at the hip to bull markets. There's just the cycle, these centrifugal forces, these sine waves between the rate cycle, market cycle, and the business cycle interplaying with each other. So I don't actually think there's a snowball's chance in hell. I'm usually somebody that says nothing is 0 or nothing is 100. There's always shades of gray. And the shades are of different color. But I think that I think a recession is frankly going to be unavoidable. I think that it's going to be either this quarter or next quarter. There's just the evidence is just so overwhelming. But I remember when I was at Mother Merrill back in 08. Let me give you an example of the same people are saying the same things today. The same people who are in the business on the long side of the trade are saying the same thing they were in the spring and summer of 08. Now, you remember back in 08, remember the recession started in December of 07. But the recessions are they're like this, it's this odorless gas. And it sneaks up on you, okay? But I'm going to tell you that after Bear Stearns got gobbled up very smoothly with the head of the Fed and the maiden lane assets by Jamie Dimon, the savior yet again, everybody said the word. Did you see what the stock market did? What the stock market rocketed after Bear Stearns got bought out, and everybody said all the housing stuff's behind us, all the bad stuff's behind us. Now, whoever thought that when New Century Financial closed its doors in April of 2007, that you'd be connecting dots all the way to Bear Stearns. But you see, Bear Stearns was like, that was it. It's like the three regional banks. Well, that's it. They've ring fenced everything. You see, in April, May, June of 08, the consensus was soft landing. I was pounding my head against the wall. I can't begin to tell you. I actually did a meeting with a famous mutual fund in Houston. You can try and figure it out who it is, where the CIO got up in the middle of my meeting and he said, "Rosenberg, you do not know what you're talking about." And he walked out of the room. And I could see the three Merrill sales guys were looking at me with their pitiful faces thinking, I guess we're not going to be writing any tickets tomorrow from this presentation. And there was people didn't start calling for recession till Fannie and Freddie failed. Do you remember in June of 08, Bernanke switched to a tightening bias in June of 08. In fact, Trichet raised rates. You know that this one former central bank, a Fed district bank president of Dallas Fed, who's on CNBC almost all the time and feted like it's nobody's business, was Richard Fisher, who everybody just adores, and I have tremendous respect for him. Nobody ever says, Mr. Fisher, why did you dissent to vote for a rate hike at the June 08 meeting? Okay, think about that. That was the consensus back then. The Fed almost raised rates. So that was the consensus, soft landing. Fannie and Freddie, that was in July, and then we don't know what happened after that. So people think they got it all figured out, but let's just face it. If you're a bull, if you're in my business on Wall Street, and you're a bull and you're wrong, you'll be forgiven to perpetuity. But God forbid, you stick your neck in the line and you're bearish. Look at how they're treating Mike Wilson on C. Oh, the thing is that, and he's been right for so long, but you're only as good as your last call. But if you're a bear, okay, and you're wrong, you're going to be treated like Daniel Day-Lewis, the butcher in Gangs of New York. You know what I mean? You're going to be chopped meat. So, but that's the nature of the business. Everybody wants a bullish story. So, okay, I want to stay in business. You see, I don't suffer from that. Okay, I don't need to do that. I really don't need to do that.
That's a gift, by the way, because
I call them as I see them. But the thing is that the bulls, people want to pay to hear a bullish story all day long.
Well, people want to be optimistic. People want to think in early April each year that their team of 32 in Major League Baseball is going to win the World Series, even though every fact in front of them suggests otherwise. And that's true with the stock market. And to your earlier point, and Danny Moses talks about this, there are zero ramifications for being bullish all the time and then being wrong because you get lumped in with everybody else. But God forbid you put your neck out and make calls like you do or Mike Wilson or some other people, and you're wrong for a week, 2 weeks, 3 weeks, just in terms of the market going sideways to slightly higher. and they're looking to Marie Antoinette your ass. And it's unfortunate, but it's true. Danny says this, I say it, Dan. People hear what they want to hear and they disregard the rest. And everybody says they want to hear the truth. The reality is people want to hear what helps them go to bed at night and wake up in the morning, David.
That's why we read fairy tales to our kids at night. But the thing is that look, it's the evidence is overwhelming that we're heading into recession. I think that you could argue that we had a longer fuse because of the Energizer Bunny, from the lagged impact of all that ridiculous fiscal stimulus checks for all and all the excess savings. I will tip my hat to those that said, you know what, this is going to buy us time. And it bought us time. It bought us time. But that Energizer Bunny is run out of batteries, right? And I think if you're taking a look at today's CPI number, what did we see? Airfares down. Hotel, motel fares down. Recreation services down. So we had the usual culprits. I mean, we knew the used car prices went up. That's temporary. We know the rents. Strip that out. Strip those out. Strip those out. There was no inflation last month.
And the liquidity portion that you talked about, Julian Emanuel talks about it. He's talked about it on Fast Money. He's talked about it with us as well in terms of, and I underestimated the amount of money sloshing around. And again, this is not political. I'm not interested in politics. They bore the shit out of me. But what we didn't mention was, the Trump tax cuts, in my opinion, came at the exact wrong time of the cycle. And that sort of got this entire thing rolling as well. And some of the things you said about 08, 09 and people saying, Stan Druckenmiller this week at Irisone was echoing some of the comments you just made as well. He was talking about the same thing that, people back in 08 were saying the same thing people are saying now. And quite frankly, I'm paraphrasing. We'll get into it in a podcast at length, but he said he doesn't really see any set of circumstances where stocks are materially higher over the next 10 years, which is way out there on the curve, but sort of echoing some of the things you said as well, Rosie.
Yeah, look, I'd say that who's going to argue with Warren Buffett and Charlie Munger, right? They can't find anything to buy. They've been marginal net sellers of stock, and they've been bolstering their cash hoard. And from a guy, Buffett, who is an eternal optimist, he can't find anything to buy. Classic value investor, can't find anything to buy. Okay, he's very patient. And by the way, so am I. Bob Farrell, I don't know if you guys watch my Merrill Lynch alumni. Bob. I mean, Bob's only been through he's been through like 6,000 cycles. And what did he say? He said that he's never seen so many false breakouts in his life than he's seen since last October. And he went on to say that he expects the October lows. Now, I know we're in May and October's around the corner, but he said, and you can't replace experience in this business that we're in. He said he expects not only the October lows to be tested, but to be broken. Now, I think that he thinks that the market will turn around in 2024. And frankly, under certain circumstances, I think he's probably going to be right. But for the here and now, I think that you got to be extremely selective, and let's not be fooled by the market. Let's not be fooled by the headline averages that are skewed by a handful of stocks. Most of this market is not behaving well, and if you look at the S&P 600 relative, you look at the financials. And you even mentioned the large caps, not just the small caps. They're thinking like, so exactly where is this bull market?
You know where it is? It's in AI right now. I mean, literally, it's to your point. It's a handful of stocks. Well, David Rosenberg, listen, Guy said we are in rarefied air when you were on the pod with us. We are. We love listening to you. You are one of my first reads at Rosenberg Research in the morning. I have breakfast with Dave. That is his daily that could hit your inbox, people. So check it out. And he also just referenced this Merrill Lynch. You had a round table, Bob Farrell, just legends, the folks that you had worked with over the years. And you host, Jeffrey Gunlock has been on them. So you have these great conversations with market luminaries. I get smarter every time I talk to you, every time I read your work over there at Rosenberg Research. So David, we really appreciate you coming on. We hope you'll come back next quarter. And listen, I just want to say this. We're not rooting for calamity here. You know what I mean? But like, to your point that markets generally go higher over time, this just feels like the sort of period here where we're about to have a little bit of a rocky period when no one is really prepared for it. So we appreciate you helping to prepare our listeners. David Rosenberg, thanks for coming back to On the Tape.
You too, guys. Great seeing you again. Next quarter, we'll compare.